among various reports from institutions about CBDCs. This one is written in the simplest terms, and it doesn't really get into the technical details too much, so it's quite easy for you all to read. After reading it, the impression I got was they had already been preparing something like this, regardless of blockchain technology. They really want this. That was what I sensed. But I thought digital money issued by the central bank, the kind you can directly trade, wouldn't actually come out. However, a digitalized payment system, issued and controlled by the central bank, might happen. That's what I thought before looking at this report. I read this book first, and then read the report afterward, which made me realize they're really planning something more ambitious. That's how it felt to me. What really caught my attention was they're fully aware of all our concerns, and they acknowledge that once this comes out, commercial banks are going to face a tough time. Right now, we mainly use commercial banks for online banking, mostly with demand deposits that we don't even intend to save for long periods. Banks use those demand deposits to give out long-term loans and make quite a good interest off it. People who don't like banks criticize them, saying they're creating unauthorized credit expansion, taking my money that's just meant for brief online use and lending it out however they please, long-term. That's the typical criticism they get. But up until now, our payment systems haven't been digitally advanced enough. So central banks and commercial banks divided the roles and managed the monetary and financial system together. That's basically the traditional monetary system we've known. But if central banks start directly issuing digital money to individuals, then it's already digital. So why would anyone bother with tiny interest rates by transferring it again to Shinhan Bank, Hana Bank, or any other commercial bank just to do online banking? The central bank's money itself can directly do online transactions. Since it's digital, it's easy to move around. But involving commercial banks might give you maybe 2% on some long-term savings. But if you're going to withdraw it next month anyway, how much interest are they really going to offer? Would you really move your money just for that? It doesn't really make sense, right? So in the report, they worry a lot about commercial banks. Because if commercial banks struggle like that, it ultimately harms ordinary people. Since commercial banks currently get funding so easily, they can offer consumers lower interest rates on loans and deposits. But if their funding costs rise, interest rates will inevitably go up. That's what they're saying. And other related problems emerge too. The Fed's monetary policies that rely on monitoring commercial banks would need fundamental revision. They talk about issues like that. But surprisingly, what they don't mention at all is, this is the US dollar we're talking about. If they issue digital dollars, and people outside the US start thinking, I want to use CBDC too. I want digital dollars. It basically becomes a global currency. Exactly what Keynes was worried about. And if it turns into a global currency, many central banks around the world would essentially shut down their operations. In Korea, sure, we might still use the won, but lots of people would flee to the dollar, especially places like China, right? Would China put up another firewall? People in Africa or Southeast Asia with smartphones, they'd all want to use digital dollars. But the report doesn't touch on this issue at all, even though it's fundamental. They don't even bring it up as a problem, or treat it as an issue here. But there's an underlying assumption here, and that assumption is the CBDC mentioned in this report is completely controlled. They know exactly who you are. The owner of each wallet is clearly identified, and it operates on permission. Not just registration, but full permission. In the Bitcoin world, it's just registration, but here it's full control. If you create a private key that matches this format, this one was generated by a machine though. But if you make your own key correctly, using dice, coins, or even certain words you choose, which can be risky, with your own words, once you've created it, an address will derive from that key, and then you can actually use it. It's basically just about registration. Just report it. Just follow the right format, but they don't need to know who you are. However, the Fed's version of CBDC isn't just money, it's more like an account. Honestly, people often don't clearly distinguish this. In the real world, money and accounts get mixed up easily. They're blended together. If I ask you, are Visa or MasterCard money or payment methods? It gets confusing, right? The dollar feels like money, but it's also a payment method. Wait, but then, are Visa and MasterCard money or payment methods? In the digital world, even the concept itself is vague. With cash, what we mostly care about is whether it's counterfeit or real. But typically, we don't really worry much about whether the person paying cash is clearly identified. Unless it's a very special situation. Like when it involves large amounts, right? In that sense, money is kind of unique, especially cash. But when it comes to CBDCs, they are not digital cash. They're just accounts. So it's even more data about you than what Visa or MasterCard have. So here's what they say. CBDC poses no worry about money laundering. They explicitly mention that with CBDC, money laundering is completely prevented without extra costs. But at the same time, they bring up another issue. Privacy concerns. Saying there's no money laundering issue means that the central bank can see every single transaction made by account holders. And that's the real issue. That's why even online banking was slow to catch on in the US. Laws vary by state. And unlike in Korea, they're really cautious. About collecting personal data, here we don't really worry much about that. But the US isn't like that at all. The US talks about how cross-border transactions would become much cheaper with CBDCs. But strangely, they're not at all concerned about foreigners freely holding digital dollars. They mention consulting with foreign central banks. But that issue itself is barely addressed. They don't really tackle it clearly. What this means is, if I wanted to get a digital dollar CBDC wallet, I'd have to give a specific reason. As a Korean, for example, I'd need a good reason. Clearly identify myself and first get approval in Korea, and then probably again from the US. But they're not talking about that kind of system here. That's not what they mean. But to protect commercial banks, they even suggest placing limits on amounts. So then I wonder, why bother with CBDC at all? If it's like this, there's no real point. That's probably what I'd have thought if I hadn't read this book before the report. It doesn't really add much value, because even they acknowledge that what we currently use is already digital. It's all online already. Even the Fed mentions it doesn't print much paper money anymore. They produce just a tiny fraction in physical form, the way dollars are created today. Since the Fed is essentially the bank for commercial banks, is by digitally crediting their accounts, just adding digital balances. And that money just circulates digitally anyway. We already use it online. But because they're so keen on competing with private sector innovation, they end up investing so much money into this, and potentially pushing aside commercial banks. But under current law, the central bank can't directly give accounts to individuals anyway. So they'd have to pick wallet providers instead. That might be banks, or even companies like PayPal. So, after thorough reviews, they'd choose wallet providers, and send the money to those wallet providers. Then these providers create accounts for individuals like me. It's different from regular banks, because while banks lend out and invest my deposits, wallet providers must hold it one-to-one. So on the central bank's ledger, the money just stays put. And transactions happen when wallet providers transfer it to me. If the commercial banking system is replaced like this, various costs could certainly go down. However, this means drastically overturning the traditional cooperation between central and commercial banks. That ensured smooth payment systems and stability for so long. So they're asking for feedback on this. Interestingly, the word blockchain appears only once, and distributed ledger also appears just once. Maybe there were more, but I noticed them only once each. Surprising, right? They talk about CBDC, yet barely mention blockchain technology. What this implies is, the author's viewpoint seems correct. In other words, completely independent of blockchain. The central bank wants to directly handle digital payments. And if this intensifies, they might even change existing laws. So the Fed could theoretically eliminate commercial banks entirely. And similarly, the Bank of Korea could directly give an account to someone like me, or to companies. Creating a system based purely on base money. Personally, I find this puzzling. Someone like me wonders, why would they go through this trouble? But after reading this book, I realized they've been dreaming of this, even before blockchain emerged. Listen closely, because the real reason is they want to implement negative interest rates. Negative interest rates, that context appears here as well, because CBDC is not cash but an account. They can charge or give interest on it. The design details determine exactly how it would work, but it could carry interest. But if they offered positive interest, people wouldn't need commercial banks. That's why they emphasize interest-free CB. Then since commercial banks do offer interest, even if I'm holding CBDC on my smartphone, I might transfer it back to a bank, use a bank's wallet and get some interest. But it's hardly anything. Like I mentioned earlier, to create an incentive. They don't explicitly say it here, but due to potential resistance, they're likely to implement negative interest rates. Currently, we do see real negative interest rates. For example, if nominal interest is 1% and inflation is 2%, the real interest is minus 1%. But nominal negative rates, they don't really exist yet. They've appeared in bonds or similar assets in Europe. Or Japan, yes. But only for limited institutional markets. Very specialized products. But applying nominal negative rates to regular people like us, that possibility is quite high, as I see it. It works like this, setting expiration dates. If there's no transaction from your wallet, for over a year you can't hold the CBDC anymore. How can they do that? After a year, it effectively spoils. Not all at once, but after a year. Negative interest kicks in. Because wallets are programmable, this level of control is entirely possible. That's why they even mention, in special circumstances, to protect the system. Placing limits on amounts. Limits on amounts? Anyway, digitizing money means it can be fully controlled. The ultimate goal is to escape deflation. There's a concept called the liquidity trap. No matter how much money you print, people won't spend it. Then even printing money won't overcome deflation. But if people aren't given cash, And everything is digital. You issue money and say, if there's no transaction within a month, it'll spoil. Negative interest kicks in. This effectively breaks the liquidity trap. That's one reason. And to apply negative interest to ordinary people, digitizing money makes sense. For the US, there's another dimension. Let me explain clearly. Central banks and corporations globally hold dollars. For international trade, they keep reserves in dollars. Holding dollars essentially means it's a claim against the US, but it never returns to the US. The dollars the US issues are held abroad by central banks and companies because they're not redeemed in the US. This money doesn't cause inflation domestically, but if the US ever decided to digitize dollars through CBDC, completely digital, though they don't do it now, if it's all digitized like this, they could, if they really wanted, without needing agreements with foreign banks, without worrying about other countries' opinions. They could allow someone like me, a Korean citizen, to directly hold digital dollars. Even if the Bank of Korea doesn't approve it, as soon as I apply, I'd immediately get it. Why is this good for the US if the dollar competes against the Korean won, and I hold fewer won, instead choosing dollars? Then from the perspective of the Bank of Korea, I was someone who used to hold 100% of my savings in won. So the Bank of Korea could print won freely, because central bank money is dead, but it's not always claimed right away. But if I decide to redeem it and convert it into dollars, then if trust in the dollar declines, various policy restrictions might be imposed. At that point, the US could dramatically expand the availability of dollars across borders, without needing approval from foreign countries, or worrying about other central banks might react. Of course, they wouldn't start this way. Initially, they'd negotiate, telling foreign governments, we'll carefully screen and give CBDC wallets only to those your country authorizes. We'll carefully assess whether they're eligible, and then issue it. They'd say, since your country won't accept it anyway, and payments won't be processed domestically. Even if someone has digital dollars, they can't directly use it in your country. So, when they make transactions, they'd have to convert it to your local CBDC within the wallet. No problem, right? It might start like this, but once money becomes fully digital, at some point, central banks worldwide will have to get into their lifeboats, facing a crisis of trust. When that crisis hits, they'll compete against each other to survive. Amazingly, the competition will directly target people like us, as central banks around the world begin competing openly on the market. If they drop mutual agreements and just freely compete, which currency would you choose? Korean won CBDC, US dollar CBDC, Japanese yen CBDC? You might pick yen CBDC, right? Maybe thinking, I don't like those Americans? Or perhaps you'd even go for the yuan CBDC? Then globally, if central banks start competing fiercely, each jumping into lifeboats to survive, who will ultimately survive? Who comes out on top? Most likely it'd be the dollar or yen, right? The Korean won? Maybe not realistically, but it's definitely possible. And in doing that, there'd be no need for negotiations or IMF mediation. No mediation required. All they have to do is grant permission, and we'll voluntarily hold dollar CBDCs. Even though it's US debt, it's rarely redeemed. We'll happily hold more of it, allowing them to print even more. And that just widens their policy options. But there's a more sinister reason, as convincingly discussed in this book. In extreme cases, in very extreme cases, they might freeze digital dollar CBDC accounts. Then it's game over globally. Similar scenarios could occur, where problematic governments could use this model once everything becomes CBDC, the kind of shutdown Greece experienced, closing all ATMs and banks. Can happen anytime just by adjusting interest rates, or other financial controls. It's like steering a ship at sea, or flying a plane through the air. When you turn the wheel, it gradually turns, but driving on land, it's immediate control. Likewise, if individuals hold CBDC wallets, central banks gain precise control. Digital CBDCs enable instantaneous, sharp controls like driving on land. Minimal waste, perfect precision. Easy control. Not spending? It'll expire. Negative interest. Don't hold too much. Capacity limits, inheritance tax, property tax. Taxes, or in extreme cases. Economy's bad right now. Freeze it. If seized, chaos ensues. Just freeze, it's digital anyway. It's trackable and specific. They can send specific messages directly. They really want this. That was the clear impression I got. Seeing it from that angle. Talking about interest rates, capacity limits, time limits, expiration dates. Honestly terrifying to even use.